Let's get more on those inflation numbers. The rate holding steady in November, although there are signs that the so-called core measures are cooling. Our guest thinks, in fact, the Bank of Canada is unlikely to raise interest rates before 2027. We're joined by Benjamin Tal, Deputy Chief Economist at CIBC. Benjamin, thank you so much for joining us. Feels like ages since we spoke. So these latest inflation numbers, will they please the Bank of Canada, broadly speaking?
I think yes. I think that the Bank of Canada is telling you that the inflation is slowing, but it's not low enough to cut again. And listen, clearly we don't want to focus on the all items CPI numbers because it will confuse everybody. Because remember, a year ago we got all those GST, HST break. Back then it was temporary basis, so on a year-over-year basis, the numbers will be poisoned when it comes to all items CPI. Therefore, the focus is on core CPI. And those numbers are okay. If you look at the last 3 months on an annual basis, they're rising by about 2.5%. So higher than the market would like to see, but clearly not the inflationary environment. So the Bank of Canada will be very happy with the decision not to move anytime soon.
There was a jump in grocery prices, and that's very visible to the consumer.
Absolutely, absolutely. This is a major issue that has nothing to do with monetary policy or even how strong the economy is. It's global issues, as we all know. Global warming is part of it. What's happening in Alberta in terms of the meat supply is one of the things. So a lot of things happening that the Bank of Canada cannot really control. So they're telling you, listen, inflation is not at 2%. And I believe, quite frankly, that the bank should cut, but they will not cut. I think that the economy is relatively weak. If you look at the labor market, I think that the recent numbers are exaggerating how strong the labor market is. Youth unemployment is still elevated. And I don't see the consumer really moving anytime soon. Investment is basically negative given the fog of uncertainty. So I think they should cut, but they will not cut. So this is really the most important thing. They will not cut. But I'm surprised by the market expecting the Bank of Canada to start raising interest rates in 2026. I simply don't see it happening. The economy is inconsistent with this kind of call.
That's interesting. Yeah, there seems to be something of a consensus emerging that we will get an increase in 2026. You think that would be premature, though, for the bank?
Absolutely. I think that if you look at overall inflation, there is no reason to believe that it will be sustainable. The Bank of Canada has been talking about, inflation due to cost push inflation. But if you look at the numbers, it's really not happening. One thing that people are talking about, and that's extremely important to understand, is the recent revisions to numbers. If you remember, Stats Canada increased their call of the last 3 years by 1.7%. And people say, you know what, maybe the economic slack is no longer there because now we are very close to potential. That's not correct. Yes, it's true that GDP went up better than expected, about 1.7% in terms of the revision, but also potential GDP went up by 1.7%. So we are still below potential. We are actually in negative output gap, and that's why it's disinflationary, and that's why inflation is not a major issue going forward.
The monetary policy, I know this is a cliche, but central bankers are at pains to remind us we can't do anything really about tariffs.
Absolutely true. I think that the people who can do something about tariff is Trump's base, and I think that if you look at what is the most reasonable narrative when it comes to Trump, I think that the narrative is that time is not on his side. In a year from now, he's going to face the voters in the midterm elections. What do you have to show for? The unemployment rate is rising. Inflation is basically rising. You have to mortgage your house to buy a banana or something. At one point, people will say, Mr. Trump, we did not vote for that. The labor market, those jobs are not coming back. And guess who is paying for all those tariffs? The consumer. This is a de facto tax. At one point, his base will say, Mr. Trump, we did not vote for that. And that's why I believe we will have to compromise. Tariffs are here to stay, but they will not be as high as they are now.
What about the outlook for the big trade deal renegotiation next year? I mean, we'll get lots of headlines and President Trump blowing off steam, etc. But will it be a big deal for the economy, or do you think there'll be major changes in that trade accord?
I think it will be a big deal over the next 6 months, because that's where we are going to negotiate it, and there will be a lot of confusing signals coming from Trump. This volatility will be there, so that will be negative for sentiment. But I think that in the second half of the year we will sign something, and this something will be by sector. So the way I see USMCA moving forward is that it will be very narrow but very deep. Namely, if you're dairy, I'm a bit worried. If you're lumber, I worry because I think that they will go after those sectors. If I'm energy, I'm not so worried. And the auto sector, I think that it will be smaller than it was in the past or currently, but it will not be devastated. So it will be narrow, but deep. It will be by sector, and I think that's the way to look at it. Is it manageable? Absolutely, it's manageable, especially with some government support to those industries.
Sorry, Benny, give us that again. Which of the sectors you think could be hurt with this renegotiation?
Yeah, I think that dairy will be one of them. I think that they were not going to compromise much, given the supply management issue. I think that lumber will be another factor, another sensitive sector that will feel the pain.
Thank you very much. Really appreciate it, Benjamin. Have a good one. Benjamin
My pleasure. Thank you.
Deputy Chief Economist at CIBC.